Good afternoon, everyone, and welcome to the first AM Motor Retail Review webinar. I'm Tim Rose, the editor of AM, and joining me today are four experienced industry executives to discuss motor retail's fight back from lockdown. So those are Steve Labar of BDO, Tim Duckers of Cambria Automobiles, Ian Plummer of Auto Trader, and Dale Wyatt of Suzuki GB. A quick note to you though before we start the discussion. You'll have joined us in listen-only mode. However, you will have a dialog box on your screen which you can type any comments or questions into. Hopefully, before we finish, we'll have a few minutes to discuss and answer some of those questions. But we've got quite a full agenda for the next 45 minutes. 4 points to cover. So we're going to talk about the June markets, new car and used car opportunities we've seen, the lessons that we've learned from social distance trading so far, how dealers are balancing the return to trading against their need to limit their cost base, and of course the prospects for Q3 and the critical steps we see for the success. So to start with then, perhaps we'll start with the June markets, new and used car. Quite a reasonable strong comeback in my view, but I saw that Mike Hawes wasn't particularly impressed and said it was barely a restart, let alone a recovery. Perhaps starting with you, Dale, to get your view on what you've seen in the market so far over the last few weeks.
I think the best way to describe the market, Tim, is steady. I think the market was down about 35%. And fleet was down 42% and retail was down 19%. And it feels to me like the market is performing at a natural level of about 60 or 70% of where I'd normally expect it to be. So I think the retail decline is a bit less than I would have expected. I think it's a little bit forced. I think we're running at 60 to 70% of retail norm.
And as a heavily retail brand, Suzuki, what's the kind of implications of that, and do you see that changing again as we kind of go into the coming weeks?
Yeah, I think it will grow. We introduced 3 phases for our dealers. The first phase was getting back on your feet. That's the phase we're in now. So we haven't applied pressure to dealers. We haven't set dealers targets. We haven't had any operating standards. We've had guaranteed margins. So we wanted to enable our dealers to get back on their feet, focus on their cash, and get the business facing the right direction. So I think steady as she goes. I think we want to have a really good Q3, but first month was about getting back on your feet.
Okay. And Tim, how about you? What have you seen? What have your staff kind of reported from the front line? What kind of picture are you getting in the market so far?
Yeah, good afternoon, Tim. We're actually very pleased with June trading. We realise it's somewhat of an aberration. You know, it's a little unusual. Exceptionally proud of our core associates that worked through June and prior to that, and they've learnt new skills and have done a tremendous job for us. This is the new car market being 35% down in a month, but nearly half of what it was last year on a year-to-date basis is clearly a massive concern for everybody. You know, from our point of view, we're losing the revenue from the sales we would have had, internal labour sales. You know, a contracting vehicle park will hit us next year, and of course the lack of part exchange, you know, is a real problem. I'm very pleased to hear what Dale had to say, you know, and we'll come on as we go into the latter questions. Dealers and OEM partners working together has never been more important as we start to go forwards, and you know, being sensible on standards, margin structures, working together on campaigns is going to be absolutely pivotal. You know, the used market is a little bit of a conundrum. It's you know, a lot of different factors are currently driving what appears to be an asset bubble, and you know, we all know the economic link between asset bubbles and recessions not being negative, but we're very cautious around that because we don't see that sustainable. So very interesting, very challenging times.
Are you seeing any sort of trends, obviously as a group where you're representing everything from mainstream to high luxury? Are you seeing a recovery of a sort across all brands?
Very difficult to say based on the June result, because a lot of it was hangover from, of course, the last week of a March is always one of your biggest delivery times. So there was a real pent up number of cars there. If I had to make comment, I would say the sort of top and bottom end of the market, possibly on very little data field, may be more robust than the sort of the segment that sits in the middle. But that's on very limited data, Tim.
Okay, thank you. And Steve, what are your meetings with your automotive clients? What kind of feedback are you getting on the market conditions?
Yeah, I think overall it's been a pretty encouraging start. I mean, as we note on the SMMT stats, that the market is 35% down, which is obviously not fantastic, but actually underlying, I think from where dealers were in April and May, I think they've been pretty happy with how June has ended up and how the return to business has been. There's no doubt that there is this pent up demand in the market. I think a lot of the public have got some cash in their hand, as in, holidays have been cancelled, perhaps taken mortgage holidays, so that there is cash and people are thinking about buying cars. So I think the clients I've been speaking to have been pretty encouraged by the return in June, and long may that continue.
Okay, thank you. Yeah, I guess the pressure now is to sustain that recovery. Ian, I think your commentary out this morning talked about record levels of interest of kind of views and leads sent to dealers in June. So there were clear signs that of a level of pent-up demand. Talk us through that a bit more, please.
Well, yeah, thanks, Tim. I think firstly, I'd sound a note of relative optimism in the numbers out from the SMMT. I think the retail market was down by around 18,000 on prior year, but from what I could gather from contacts with various OEM colleagues, the numbers for the last couple of days that were pushed through, as Dale said, often forced through, were down around 18,000 compared to last year. So that would give an indication that it's a bit more natural level of demand. We've taken out some of the overheating by doing what we've done, by, like Dale suggested, not putting onerous pressure on retailers and so on. And equally, if the short cycle fleet channels are down, the likes of rental and so on, there aren't many rental companies buying lots of cars just now. That's not a bad thing in terms of taking out some of the heat on both the new market and the flow through into the late plate used market. But we've seen, as you said, we've seen a record number of visitors. We expected a return of pent-up demand, and we commented on the fact that the market seemed to be very much paused, not stopped during lockdown, based on everything we could see on our site. So we had 64 million visits, a record during last month, with 17.5 million users spending about 10.5 million hours on site. And most importantly, that translated into actual demand. So the lead volumes grew by 90%. That's a sign of real tangible interest. And that seems to be flowing through from what we can see into the new car numbers we just talked about, but equally into used car numbers, where we don't have the stats just yet, but from everything that's being reported anecdotally and by retailer partners we're working with, there does seem to be a level of positivity out there and numbers that were ahead of prior year.
And there was a lot of talk.
Tim, just one other comment from me. One other comment from me, Tim. It's worth noting that whilst we've been open for business, the logistics chain is still catching up. So there are a lot of orders that are not delivered at the moment. So I think logistics is another reason for the downturn in the month of June.
What is the hold up there then, Dale? Is it just getting everything rolling again?
Yeah, just the logistics companies still have furloughed drivers. We're getting back to normality in terms of delivery capacity. So there are a lot of dealers still with sold orders awaiting delivery. There were vehicles that were sold in the month.
Okay. So does that then suggest that things will look more positive in the weeks ahead as more of that comes into play? So actually the recovery could even strengthen?
I think so, yes.
Okay.
I think the same thing will help the return of fluidity into the market generally. There are a lot of road hauliers that aren't back on the road, as Dale said, which hinders the operation of the auctions. And if the auctions aren't able to flow smoothly, then that really slows down the whole pipe. The pipes are slower, so the whole chain is disrupted. And equally, if cars are in the wrong places, then leasing company returns, finance returns, rental returns, and so on are harder to manage. Mobility are a similar issue. All of that does slow down the fluidity of the market that we need for an efficient marketplace.
Okay. And there was a lot of talk in the kind of run up to release from lockdown of a anticipated boost in demand, I guess, for lower priced used cars or older used cars after the government came out to advise people to steer clear of public transport where possible. Are any of you seeing any evidence of that come through? And Tim, perhaps as a business, have you geared up to cater for that?
Tim, there's certainly been a very significant demand for exactly that sort of price range used car. That's quite normal. That is always in demand. The lower end, good quality used car. But particularly given the fact, as you talked about, people not wanting to use public transport, certainly the wholesale used car market has been exceptionally strong.
And Tim, I think that's also noted. I think you put something on AM online a couple of weeks ago about, was it Imperial Cars were going to have their record month in June, which sort of justifies your point, doesn't it?
Mm.
Sorry, Tim, I was just going to say we did some research on that subject of consumers who are probably looking for an answer to this private public transport and private space kind of issue that we're all feeling a little bit at the moment. So what we saw is that 42% of people are looking to replace a vehicle right now, but actually 58% are looking for either a new or additional car. Of that, 42% of them were people who don't have a car or wanted an extra car in their household. 16% though specifically said they wanted to get a car in order to help avoid using public transport. And the majority of people who actually use public transport today, 56% of them, and who have a driving license, now plan on buying a car. When we can see many will buy a bike, an e-bike, a scooter, something different, but many will end up buying a car. And we're seeing that in the numbers of searches and now the values of the vehicles of the older age categories, where the values of cars over 10 years old increased by 6.7% like-for-like basis this month just gone compared to June 2019. That was higher than the late fleet vehicles, but equally 5 to 10-year-old vehicles grew by 7%. So some really strong numbers there that just reflect the demand for that kind of price of vehicle.
So I guess one message from that, Ian, is that while obviously with older, lower price cars, the margin can be slightly tighter, but actually a message there is that clearly there is demand, so dealers don't need to discount particularly to get stock shifted.
I think we're seeing that across the board right now. The level of supply is slightly constrained for the reasons we touched on, logistics and so on. But the level of demand is very high, and that simply creates a dynamic where prices can remain very strong. So overall, across our retail price index last month, we saw a growth of 3.7% like-for-like for the month. That's on the back of two smaller months of increase in the last couple of months. So it's a strong trend, but that's reflecting clearly this level of pent-up demand that's flowing through into the market, and it reflects the reality of the fact that retailers aren't actually repricing because they don't need to. We're still seeing roughly a third of retailers who aren't changing the price of their cars. In lockdown, that was 2/3 compared to sort of normal levels. And when they are changing, the average is around £250, and that's at the very low end of what we normally see. And around a quarter of them are actually increasing prices. So there's plenty of opportunity there.
That's great, thank you. Dale, moving on to social distance trading. I mean, as a manufacturer, what guidance did you provide your network prior to reopening, and what kind of feedback are you getting back from them on how themselves and customers are adapting to the new ways of the new experience in dealerships?
In terms of guidance, we gave them regular briefings following on from the government's daily meetings. We provided the dealers with point of sale, and we created a whole suite of customer reassurance videos that dealers could use. And our experience has been anecdotally that customers have been very accepting of the new environment, and we thought the customers may be challenging, and then there may be some problems. But in our experience, customers have been very respectful of the environment, and very easy and accepting of the new world.
Tim, are your GMs reporting similar experience from your sites?
Yeah, yes, they are, Tim. We've kind of grown with the whole the new that is a social distance showroom and service environment. You kind of get used to it. As we've gone through the process, we've realised that you can make better use of the showroom and reduce time by making sure all the showroom cars are cordoned off. That doesn't mean that you can't go and interact with the product, but at least if we can interact with one guest, one product, we don't have to clean the whole showroom. The difficulties have come where we've had people unfurloughed and back into the business. They haven't been used to operating in a COVID safe environment, so that takes a bit of time. And we're desperately trying to cling on to 2 metre distancing, even though the government guidelines would have less restriction on that.
I guess that's from what you were saying, it's a constant challenge that you're bringing more people back as the market continues to build, but you're then having to bring them up to speed with people who may have been in the business for a few weeks by now.
It's just constant reminders, Tim, because if you've been at home for the last number of weeks, it's not usual because you're not social distancing with your own family clearly, and it's important for all the rest of our associates and our guests, our customers, that they feel confident in and around our associates, but they get the hang of it very quickly.
And have you had to take slightly different approaches in certain brands, or again the kind of ultra luxury kind of segment to how you have in some of the other businesses?
We've very early on we produced our COVID reset document, which of course we've got different scales of business, but predominantly the processes are exactly the same, making sure, as Dale said, we're using all the right signage that's very clear, and making sure people are temperature checked on the door. And again, we've had no pushback really. Everyone understands that it's only good practice to protect us and our customers, I guess.
Okay, thank you. Steve and Ian, again, the feedback that you've had from clients, are they finding that customers are quite accepting of how we have to work now?
I think Steve's just dropped off. I can't see him anymore, so I'll answer right in there.
There we go.
So we have seen a definite trend towards more comfort, if you like, in the minds of the consumer regarding how they're perceiving the visit to a retailer. So literally over the last weeks, the level of ease with which a consumer engages with the retailer physically is definitely increasing. Now we're seeing a growing proportion, 3/4 of people who are quite happy at the idea of engaging with retailers, principally because they've been given really good guidance. They're really appreciative of the communication from retailers, and every website has been updated. We've got information on the full page ads of cars that are on our site with retailers' information about what they're doing and so on to improve the sanitary measures that are on site and manage the safety of customers. Appointments are being made. So generally speaking, people are quite happy with that, getting more and more comfortable.
Yeah, I think I'll just echo that, Ian. I think everyone is realising this is the new norm, and everyone is very accepting of it. Everyone appreciates it. things need to be more regulated and timescales and meetings set up. But from everyone I've talking to, that it seems to be everyone is engaging in this new norm.
I think that as you were just saying, Ian, the communication that dealers are having with their customers is key. I know from our own experience, my wife had to book her car in for service pretty much the week we all came out of lockdown. Was sent a very informative video to watch the night before, talking about the process of arriving and going through the entrance and following the pathways and that sort of thing. And I think the great examples really from dealers on how to reassure customers and keep them informed on how the process may have changed.
Yeah, completely. I take my hat off to what retailers put so much work into all those measures, and seen so many great posts that people have been putting out there, sharing their experience. It's been a heck of a lot of work, but it does seem to be paying off. The thing I just say though, Tim, is that the consumers are still keen to visit retailers, and more so as they get more confident. What has changed though is that we're seeing that consumers are keen to do more of the sort of higher funnel, if you like, aspects of their car buying online now. I was struck by an ONS stat that said that we buy 1 in 3 of our our retail products online now, and it used to be 1 in 5 a year ago. So we're generally engaging as consumers much more online, and that's happening in the car buying journey as well, where we're seeing 42% of people saying in a recent survey we did a couple of weeks ago that they're doing more in their car buying journey online than they were before. The remainder, most of the remainder is sort of the same. So what we're seeing is people doing things like checking availability or checking even features of a car in phases online where they would have been previously perhaps doing that in a physical part of the journey. We're seeing a real acceleration of digital, I think, because it's what we're doing as consumers, and now we're able to do it in cars as well.
Okay, thank you. And so on to the point about the balance between the need to return to trading and obviously keeping it profitable, keeping the costs low. Dale, you were saying earlier about some of the support measures that you've put in for your network. How do you foresee that continuing or helping them as the market begins to pick up even more strongly?
I think it's about confidence. I think, as I said, we introduced the back on your feet stage and said to the dealers, manage your cash, look after your order bank, seek out the low-hanging fruit, your finance renewals and your mobility renewals, and get yourself ready to retail, get your virtual and physical world sorted out. Those are the things that we worked on, and once you're back on your feet, we can then talk about getting up and running. And for us, up and running is about being clear about your new organizational structure. I think there are a lot of businesses with still a number of staff on furlough and haven't worked out what the structure is for the future. And if we're going to have a strong Q3, we need a motivated, aligned team with certainty around their jobs. So I would encourage dealers to plan your organizational structure and get on with it. If there are going to be cuts in your business, get them done. And then I would say, get your digital roadmap sorted. There are lots of changes with dealers in terms of digitally. Lots of people moving to reserve a car functions, buy a car online, virtual showrooms, and pick your path and get that squared off. And then I would say, get your new processes sorted out. A contact list requires new processes for sales and after sales, and get them written down, get them implemented, get your budget in place, and then try and get your change mindset. If we're going to have a really good Q3, we need to change our mindset now over the coming weeks from getting back on our feet to getting up and running. So I think there needs to be a change in mindset over the coming weeks if we're going to have the quarter we deserve.
Okay, thank you. And Tim, again, in your business, obviously you need to ensure you can recover as much profit as well as revenue that you lost during lockdown. Talk me through some of the activities that you're doing there, or the measures, I guess, that you're keeping a close eye on to do so.
Yeah, Steve wrote a very good article recently. The whole industry was facing significant headwinds even prior to COVID, in terms of rising costs of wages, pension, emissions, dropping new car market. So as soon as we got into this COVID phase, we we knew very quickly as we came out of this, we would have to do things very differently, and we communicated with our associates right the way through the COVID period and made no, never sugarcoated the fact that there may need to be some significant changes to the numbers of us that will come out the other side. And I think, it's an overused Pareto 80-20, the law of the vital few. What we have found on the way through this is we're going to end up with smaller teams, doing better quality business by multi-skilling, by touching things once. If we take June in isolation, we would ordinarily, an average sales associate for us would do 14 vehicles a month. Of course, we span from high luxury right down to volume, so there's a big gulf in between that. But in June, they did 27. Now, that, the sustainability of that, I know people will question. Likewise, in our service departments, overall efficiency was up by 15%. So by having, the really high performing people back in, have made a massive difference. However, we know to make it sustainable, we're going to have to adjust the processes, streamline them, use technology, embrace it, and use that to make the fewer people, the lower cost base, sustainable, whilst giving a great guest customer experience. But just little anecdotal things. We found that during the period, we had some general managers who chose not to run with a traditional telephony reception, and they chose to have other people in the business instead of that role. They found they were 19% more effective at not missing calls, and that was a real surprise. We didn't anticipate that, because of course what you're finding was, rather than it coming into a single point, the first engagement on the telephone, it was going to people in a much smaller team who had broadly upskilled themselves very quickly and who could deal with a sales, a service, a parts inquiry without having to transfer it. And that's something we've all been looking at. The last 20 years I've been in motor retailing, but we've never managed to get there. Now we're going to have a little choice to have to go and change the way that we do business to keep the cost base at a place that we can make a return.
I guess it sometimes takes major events to drive change in any industry. Do you see that, Steve, and your kind of experience as well?
Yeah, absolutely. Yeah, I think COVID has only accelerated, as Dale and Ian and Tim have already alluded to. It's only accelerated the move to digital and multitasking and everyone being able to job share and do other parts of jobs. I think overall, Q3, everything I'm hearing, Q3, we hope will continue to be a good quarter. There's still some pent up demand within the sector, so we're hoping that Q3 continues in the similar vein to June and continues to grow. Having said that, there's no doubt there will be difficult decisions to be made over the next 3 to 6 months. I suppose we mentioned furlough, and obviously groups are bringing staff back from furlough, and there still are a number of people still on furlough, so it'll be a decision as and when they come back. I suppose if there's a word of caution, with my accountant hat on, is that HMRC have now set up a furlough unit, so they will start to be looking at all sorts of businesses, not just motor traders, and doing review of those businesses to make sure that people were properly furloughed in the period of time that they were on furlough. So I would just encourage all dealers on the call and elsewhere just to really just look through how they furloughed people and what people were doing. In theory, if they're on furlough, they should be doing no work whatsoever. So I just a word of caution, just to be very careful of how those people were furloughed over the last 2 or 3 months.
Okay, thank you. And Ian, what's your advice to dealers in terms of ensuring they can trade as profitably as possible over the next few months?
Well, without wishing to make it sound like a self-serving approach, there is a logic that we talk to around if it isn't online, it isn't for sale. Right now, with consumers doing all that research that we know they do, 95% of them spend 14, 15 hours before COVID, more since or during and now since online. And when they're turning up at retailer, it's usually for an appointment, and often for those further down the funnel sort of parts of the journey. So it is vital that cars are visible. And as I said, consumers are more engaging with those higher up sort of aspects of the funnel of car buying in an online manner. So they need to have that visibility. But what I'd say particularly is that that's got to allow a reshaping of the retailer's business, because we know that research we did just recently showed that 8 in 10 people are open to the idea of buying a car either online or over the phone. That could be even these days with a Zoom call or a Teams chat with somebody. And there's an awful lot of good examples of that, and video is becoming more and more embedded in retailer processes. That doesn't mean to say by any stretch of the imagination that for a minute I'm saying that the majority of people want to buy fully online. That's only a minority. But what they do want to have is this blended, seamless journey between physical and digital. And so as we get to this sort of horrible buzzword of omni-channel, which is no more complicated than saying I can use different channels to actually sell or communicate to my customers, whether it's physical or digital, and a mix of both. We've got to make sure that we reshape the business, as I think Tim touched on, and Dale. We need to make sure that we're not just adding in a layer of cost. If we are spending more money on digital because that's where the consumer is and where they want to be for many parts of their buying experience, then we need to look hard at the remainder of our cost base, and potentially, as Tim highlighted, in particular, bring back the people that really fit, reshape mindsets. As Dale said, I completely agree with that. Focus on trying to redo business in a better way, rather than back to business as usual. Back to a better business would be a key highlight for me.
Just on that
just
mindset,
on the digital journey.
Sorry,
just
Dale,
commenting on the digital journey. Just commenting on the digital journey. As a manufacturer, 18 months ago, we were focused on getting dealers to acknowledge there was a lead in the system. And then it was about speed of response. So it went from same day to 30 minutes. And then it was about content. And now I think it's about speed, content, personalized content, and professional content. So the expectations of a dealer to reply to an online lead are very, very different than they were 18 months ago. Just to reply isn't enough now. It's got to be content-led, professionally done, and personally delivered.
The skill set there is very different, isn't it, Dale? And as is the mindset requirement, because we know, I've worked in retail many years, and you guys will all know that it's very common to hear a sales executive say that they're great at dealing face-to-face. And when the customer is face-to-face, that's exactly what's expected of them. But these days, they need to have a skill set that's much broader, or the shape of the business needs to be different so that we can deal with those online inquiries in a smarter, more tailored way, to personalize and so on. But we're seeing numbers of leads that are being dropped in high percentages that I'd rather not quote on this call, but a large amount of customers will end up being missed, I think, at the moment. And that's a really tricky balance for a retailer who's got to juggle the cost equation of bringing people back to the business, which can be really knife-edge stuff in terms of profitability impact, but equally the risk of missing some consumers.
Well, I think most of you mentioned technology kind of in your answers there. I mean, are we likely to see a significant increase with dealers investing in technology to perhaps automate some of the functions that can be automated effectively in the months ahead?
We're definitely seeing that. We've seen a huge acceleration in digital engagement generally. We take the one example of the new car side of our business. Our new car audience has grown massively, as has the stock provided by retailers and the feeds for stock or finance provided by manufacturers, as everybody's engaged with that process. But I think there are key parts of that sort of online buying journey that currently are very tricky, and that are generally the biggest crunch points for the consumer, as well as time consuming and tricky for the retailer. Take two examples: finance and part exchange. You can arrange the part exchange of your vehicle by guaranteeing a value, for example, online. That takes away a contention in the buying sort of discussion between sales exec and consumer. And equally, if you can get rid of the finance discussion, let alone in a closed room with a business manager that a consumer doesn't like, and bring that to a more transparent online approach, that allows the retailer discussion to be much more about the value add they can bring. So from what we can see in good examples where that's happening, it allows better retained margin, better consumer experience, so it's good all round.
And where you said about resetting the mindset, that's Dale and Tim. Was there any evidence of as staff came back to business after lockdown of levels of kind of reticence or any psychological kind of scars from the 2 months that we've all spent stuck at home? And if they have, how have you been able to kind of deal with that while bringing back the business?
Well, I've got nothing but respect for the dealers. The dealers came back after a period of incredible having to come back with a skeleton team and achieve miracles. And dealers have been reactive rather than proactive. And we know the icing on the cake, that last 20% of the volume is about proactivity. And I think dealers have been spending too much time putting out fires, dealing with order banks, trying to get back on their feet. So I think it's that proactive element. It's that finance renewal. It's that PCP renewal. It's that extra mile. Those are the things that are missing at the moment. So for me, it's about having an expectant mindset and making sure that dealers are planning for the quarter they deserve.
Yeah, I think Tim, every one of our associates that's come back into the business has been desperate to get back into the business because they're ready to come back from furloughed status. They've all come back with an exceptionally positive mindset. That they've understood that we have to do things differently with a much smaller proportion of the staff that we had, the associates we had before COVID on the floor. They had to go and learn new skills. It was interesting that Ian talked about the use of FaceTime, Microsoft team meetings with guests, because what we can't at the moment offer. What I think the phrase at the moment I heard is, and it's quite a nice one, is mouse to house. We can't do that right now. We can't go right through the journey, but what we have done, we've learned to do during COVID, and that's been driven by a lot of our associates and their ideas. Because I'm a little, as you found earlier on when I was trying to log on, I'm a little bit of a techno Luddite, but fortunately we've got some very, very bright young people who have embraced technology, added it to make a bespoke experience. We know we can't do mouse to house, but what we have done is made a far better buying experience by having someone. People still, we believe, want to interact with an individual. If they can do that in this sort of media, then it gives them a real sense of trust, and that's not just on the sales side, that's on the after sales side too. So we've been very very grateful for those for our associates coming up with ways to do things differently and better.
Fantastic, thank you.
Just a reminder, I think, Tim, I think just to finish off there, there's no doubt technology is going to help the process, but I think fundamentally consumers, customers still want to come into that physical showroom to have a look, touch, talk to someone, and just touch and feel the car. So I don't see that changing sort of any time soon.
Certainly, absolutely. Just a reminder, there is still time to post your questions. We've had a couple come in, which we'll deal with in a moment, just after the last point on the agenda, which is Q3 really. What are the prospects for September? Do we see it being a really strong month that's going to help to recover some of the lost ground that we've suffered in 2020? Who would like to go first on that one?
I think everyone's hoping that Q3 will be a very strong quarter and September will recover. I suppose there's a question mark about supply of new vehicles, and Dale talks about logistics as well. But as you say, used cars are still very, very strong. I think the biggest challenge will probably be Q4 rather than Q3. So I think hopefully everyone on the call and listening in will say, very much hoping for a very strong Q3. I think in terms of critical steps for that success, again, it's for the retailers, keeping very close to manufacturers and all their funders and bankers who've obviously been very supportive to date. And then, as everyone said, it's just keeping closer than ever to those customers, working through the PCP deals, etc., etc. So there definitely is the market out there. We just need to grab it for 3/4 and then hold on to it.
Demand still feels relatively robust, Tim. I think the big question that's on everybody's lips is, was the level of demand we saw in June just the result of the fact that people were locked up and then they could finally get out and buy a car? It seems like so far that's not the case. We've just done some research. We've been doing it virtually every week through the period of the COVID crisis, and tried to share that on all the media channels we can with our audience and so on, and the networks, to try and make sure we share that insight. But for example, in June, 33% of Auto Trader users were looking to buy within the next 3 months, and 50% were looking to buy within the next year. And that's increased in the first phase of July to 38% in the next 3 months, and 56% in the next year. So that's the positive sign just in the last week. Those numbers grew throughout the lockdown period as confidence sort of seemed to edge upwards. At the tail end, there is a small but growing number of people who are saying they are putting their car purchase off. Went up from about 3% or so at the start of lockdown to about 8% now. That might be the beginnings of the impact of unemployment levels and so on, and fears of unemployment. So that's a concern. But I think if you look at the two markets, on the new car side, most seasonalized numbers I've seen suggest that from September onwards, we need to do equivalent numbers to last year. If you think about where we are today, we're around 650,000 cars. The SMMT forecast is around 1.67, if I remember rightly. So we need to do roughly 1 million cars in the next half year. That's roughly the same as we did last year. So we're going to need each month to be pretty strong just to hit a number which at the end of the day is 27% down, so it's pretty nasty. But more importantly, I think the used car market is very much more robust. When we look back over prior periods and look at previous recessions, the used car market of around 8 million cars, obviously nearly 3.5, 4 times bigger than new cars, hardly ever swings more than a couple of percent. Very rarely has gone over 5, and is more resilient. From what we can see already from the transaction data, it looks like that remains relatively, a source of relative optimism as things pan out in the weeks ahead.
Yeah, I'd agree. I think, as I keep talking about confidence, I think dealers know how to maximise a quarter and maximise a plate change month. And it's about not forgetting that knowledge. That hasn't changed. So incentivizing your sales team, having an event strategy, being proactive, all of the things that have always worked still work. So it's a case of not forgetting the basics, I think.
I think, Tim, for me to make this happen, and I maybe sound a little negative, but I think when it's like this, it's important to look at some of the factors that are going against us. We're certainly seeing the effects of a number of things taking people out of the new car market. Payment holidays. So we've got instances where they've gone from 3 and are looking at extended to 6 months worth of payment holidays. Whether they need to or it's strategic from a consumer point of view, it's certainly taken them out of the market for that period of time. We're starting to see some evidence of, as we assumed would happen, more stringent underwriting. So even if you can sell the car, getting people through finance is starting to be increasingly more challenging. Certainly if you're self-employed, there are certain finance houses that will be are interviewing individuals to make sure they have the ability to pay. That can be fairly tricky to prove if you're self-employed. So there's a couple of bits there that are pushing back against us, which is why, as I said at the start, we just need to work with Dale and his peers to make sure we've got some great consumer offers that we're coming up against the challenge of people having no positive equity. So we need to think about how that how that happens, and to work with the finance houses as well to go past all of the bits which I said earlier. Of course, you've got in the backdrop, you've got anticipated VAT changes, which are, certainly at the higher end of the market, the HLS end, a 2.5% or 5% drop in VAT makes a considerable difference to the purchase point. So we've started to, to come in and up against that. And amongst all that, we've got some WLTP cars that we've got to go and collectively deal with. Differing amounts in differing manufacturers. And we also hope for good news on Wednesday when Rishi Sunak, hopefully comes with some additional positive news as to how we steer our way out of the COVID period.
Hopefully, a few months to stabilise, and things will be looking even more kind of positive for the end of the year. We've had a couple of questions come in. If I can just very quickly seek a view on those. Similar to what we were just discussing, US-based dealers are seeing strong demand returning. Is there any reason why the UK market shouldn't follow? I think we've just kind of discussed that in a way. Or does anybody want to add anything to that? No. What does the panel think about used car offers within a potentially shrinking market? Should there be some activity to encourage consumers improve the offers on used car? Is there any scope for that, do you think?
I think there's good logic for that, Tim. If a brand in particular has the belief that their network won't be able to handle all of the a sufficient proportion of the brand's stock, whether it be stock that they're sourcing directly in the retailer or remarketing stock coming from the brand. And brands, obviously, captive finance houses will have good visibility of what's coming through, what's held back from leasing companies and so on, rental returns that are coming back in and so on. Then it definitely makes sense for the brand to incentivize the sales of any used car by their retailer networks in order to create the necessary, if you like, pull on their remarketing cars and a natural flow through of those vehicles. Brands will be conscious that they're likely to get a slightly higher value for cars sold through their franchise networks, and therefore that's a key part of maintaining residual values. And that's one of the crucial factors we're looking at the moment in the market. If the interest rates stay low, obviously they're historically low right now, and if values stay as strong as they are, that at least gives us a good chance to go to market both on selling the new cars that are supported by the strong RVs that we're planning for the future on, and of selling those same used vehicles. So hopefully we can, as an industry, remain focused on the actual data of what the new used car valuation story is telling us.
Thank you. Just quickly do one last question because I'm conscious we're a couple of minutes over time. The point that you made, Dale, about being proactive. Question: does the panel see dealers embracing working more closely with finance partners, a bit like you were saying, Tim, as well, the issue with PCP renewals, so that they can drive renewals and finance opportunities?
Yeah, definitely. A huge opportunity for the dealers. We've been successful as a market at selling PCPs really well. And every dealer in the land is sat on a big PCP renewal opportunity going into this quarter. And I would say that was low-hanging fruit. So definite opportunity there.
Fantastic. Okay, well, I'm afraid we've come to the end of the time we'd allocated for the webinar. So I would like to thank you all, Dale, Tim, Ian and Steve, for taking part in this. Viewers, should you wish to watch it again, you can watch it at your leisure through your registration link. I would like to say please do join us again for the next one of these, which will be on October the 6th. So we will have the September plate change registrations to discuss at that one. So again, thanks to all the participants this afternoon, and thank you to the audience for joining us. All the best.